I want to describe a specific moment. You found out you were getting a raise. It might have been a conversation with your manager, a letter in your email, a notification in your HR portal. Whatever the delivery mechanism, there was a moment, a real physical moment, of relief, of recognition, of feeling like the effort had finally registered somewhere in the system, and the system had responded. That feeling is real, and it deserves to be named, because it was not naive or foolish. It was the correct emotional response to information that on its face said, your situation is about to improve, and then the first paycheck arrived. And you did the math. And the improvement was smaller than you expected, meaningfully smaller. You got a 4% raise, and your take-home went up by something closer to 2.5%. Or you got a 10% raise and your net pay increased by 6%. Or you crossed some invisible threshold and discovered that not only did your raise not feel like a raise, it actually felt, in a way that seemed impossible, like you were slightly worse off than you had been the month before. The numbers did not add up to the thing you had been promised, and you did not fully understand why. You had a general sense that taxes were involved, but the mechanics of exactly how and why, and what it would have taken to actually improve your situation by the amount the raise suggested, that was never explained to you. It was never going to be explained to you. And that gap between the promise of a raise and the reality of a paycheck is what this video is about. Before we get to the mechanics, and they are genuinely clarifying once you see them laid out, I want to stay with something about that moment of disappointment, because there is a specific kind of financial confusion that it produces. It is not just confusion about tax rates. It is a deeper disorientation about how the system works. You did the right thing. You performed well enough to earn more. The number your employer agreed to pay you went up, and yet your experience of having money did not change in the proportion you expected. This produces a specific frustration, not quite anger, not quite resignation, that sits somewhere in the middle. A feeling that the rules of the game are not what you were told they were. And a suspicion, usually unspoken, that there is a layer of the financial system that you are not seeing clearly, that educated people understand and navigate, and that no one has ever taken the time to explain to you directly. That suspicion is correct. The layer exists. It is called marginal tax rates. It interacts with a set of mechanisms that include payroll taxes, bracket thresholds, benefit clawbacks, and the loss of income-tested programs. And the result is a combined effect that economists call the effective marginal rate, the actual percentage of each additional dollar of income that you do not get to keep. That number is almost never the number quoted to you when people discuss tax rates. It is almost always higher, sometimes dramatically higher, and in certain specific income ranges that tend to cluster around the incomes of exactly the people most likely to be watching this video. It can produce the genuinely counterintuitive result that earning more money, after all the mechanisms have run their course, leaves you with less money available than you had before. The story I want to tell you today has 3 parts. First, the math, the specific mechanisms by which additional income is taxed, clawed back, and reduced in ways that are rarely explained in combination. Second, the system, who designed these thresholds, why they land where they land, and what political and institutional forces have kept them exactly where they are for decades. And third, the honest exit, what you can actually do within the existing system to keep more of what you earn. Let us start with the math. Let us start with the piece of the tax system that is most widely misunderstood, because misunderstanding it produces the single most common and most damaging misconception about raises and income. It is the concept of marginal versus effective tax rates, and the confusion around it is so pervasive that I encounter it in conversations with otherwise financially sophisticated people regularly. The misconception runs as follows. If I am in the 22% tax bracket, I pay 22% of my income in federal taxes. This is incorrect. It has never been correct. And the fact that it is so widely believed is one of the more consequential pieces of financial illiteracy in circulation. because it causes people to systematically overestimate how much of a raise they will lose to taxes at higher incomes, and in specific circumstances, to underestimate what is actually happening to them at certain critical income thresholds. The United States federal income tax system is a progressive marginal bracket system. This means that each bracket rate applies only to the dollars of income that fall within that bracket, not to your total income. If you are a single filer in 2024 and you earn $60,000, you pay 10% on the first $11,600, 12% on the next $35,550, and 22% only on the remaining $12,850. Your effective tax rate, the total taxes paid divided by total income, is approximately 15%. But your marginal rate, the rate applied to the next dollar you earn, is 22%. Those are two different numbers. And when your employer gives you a 4% raise, the raise is taxed at your marginal rate, not your effective rate. If you are in the 22% bracket, roughly 22 cents of every additional dollar of your raise goes to federal income tax, not 15 cents. Now let us add payroll taxes, because federal income tax is not the only thing happening to your raise. The Federal Insurance Contributions Act, FICA, requires employees to pay 6.2% of wages toward Social Security and 1.45% toward Medicare, for a combined 7.65% on every dollar of earned income up to the Social Security wage base, which is $168,600 in 2024. Your employer pays a matching 7.65% on top of that, a cost that economists generally agree reduces the wages employers would otherwise offer, meaning the economic incidence of the employer portion falls substantially on workers rather than employers, even though the worker never sees it as a line item on their pay stub. Adding the employee side payroll tax to the 22% marginal federal income rate produces a combined federal marginal rate of approximately 29.65%. Before state income taxes, before any interaction with means-tested benefits, before any of the mechanisms we have not yet discussed, state income taxes vary considerably, from 0 in states like Texas, Florida, and Washington, to 13% at the top marginal rate in California. For a worker in a moderate tax state paying 5% in state income tax, the combined marginal rate on a raise is now approaching 35%. This means that a $4,000 raise, $160,000 at 4%, translates to approximately $2,600 in additional net annual income, or about $216 per month. That is real money. It is not nothing. But it is meaningfully different from the $4,000 improvement the gross figure suggested. And we have not yet touched the mechanism that produces the most genuinely counterintuitive outcomes, the benefit cliff. The benefit cliff is the phenomenon that occurs when additional income causes a household to lose eligibility for income-tested programs, Medicaid, the Children's Health Insurance Program, housing subsidies, child care subsidies, the Earned Income Tax Credit, the Child Tax Credit Phase-Out, SNAP, and others, and the combined value of those lost benefits exceeds the net income gained from the raise. This is not a theoretical problem. It is thoroughly documented in the academic literature and in government reports, and it occurs with predictable regularity at specific income thresholds that cluster around the wages of lower middle-income workers, exactly the workers most likely to describe the experience that opened this video. That scenario is not extreme. It reflects documented outcomes in multiple states for families at specific income thresholds. The Urban Institute's marginal tax rate calculator, which models the combined effect of taxes and benefit loss across income ranges, shows that effective marginal rates in certain income bands between $20,000 and $60,000 for households with children can exceed 60%, and in some specific cases in states, exceed 100%. Meaning that an additional dollar of earned income actually reduces total available resources by more than $1. Economists call this range the poverty trap or the benefit cliff zone. Workers and families who live in it describe it as, "I got a raise and somehow ended up worse off." Both descriptions are accurate. They are describing the same mathematical reality from different vantage points. The mechanisms I just described, marginal tax rates, payroll taxes, benefit phase-outs, were not designed together with the explicit intent of producing benefit cliffs. They were designed separately by different legislative sessions at different times for different stated purposes. The trap that results from their interaction is, in the language of policy analysis, an emergent property of overlapping systems rather than an intentional design. But, and this is a point that deserves emphasis, the trap has been thoroughly documented for decades. The Congressional Budget Office has published analyses of effective marginal rates in cliff zones. The Urban Institute has published the marginal tax rate calculator I referenced. The National Bureau of Economic Research has documented the labor supply effects of benefit cliffs extensively. The information exists. The political will to address it has not materialized consistently, and the reasons for that failure are themselves a story about who benefits from the status quo. Let us start with bracket creep, or more precisely, its absence. For most of American tax history before 1985, the federal income tax brackets were not automatically adjusted for inflation. As wages rose with inflation, workers moved into higher marginal brackets even if their real purchasing power had not increased. In 1985, indexing was introduced. The bracket thresholds are now adjusted annually for inflation, preventing the most direct form of bracket creep in the federal income tax. But the benefit program income limits that determine eligibility for Medicaid, SNAP, child care subsidies, and housing assistance are set by Congress and adjusted sporadically, not automatically. In practice, many of these thresholds have not kept pace with either inflation or wage growth, meaning that workers cross eligibility cutoffs at lower and lower real income levels over time. The tax system adjusts for inflation. The benefit system does not. And the gap between the two creates zones of compounding marginal penalty that grow larger and affect more people with every year of wage growth that moves workers across static benefit thresholds. The payroll tax structure compounds this in a specific way that is rarely discussed in mainstream financial coverage. Social Security contributions are capped at the wage base, $168,600 in 2024. Above that threshold, workers pay no further Social Security tax, meaning that the highest income earners in the country face a lower effective payroll tax rate than workers below the cap. A worker earning $50,000 pays 6.2% of every dollar in Social Security taxes. A worker earning $500,000 pays 6.2% of only the first $168,000, an effective rate of 2.1% on total income. The payroll tax is, in this sense, regressive. It takes a larger percentage of income from lower wage workers than from higher wage workers. This was a deliberate design choice made in 1935 and never substantially reformed. The political economy of Social Security has made the cap effectively untouchable because the constituencies that benefit most from keeping it, very high earners, have disproportionate political influence over the legislative process that would need to change it. The benefit cliff is, in many ways, the most politically durable part of the trap because it is the product of a structural conflict within the political economy of social insurance. The programs that create cliffs, Medicaid, SNAP, housing assistance, child care subsidies, were designed to serve the poorest households. Extending eligibility higher up the income distribution requires either larger program budgets or stricter benefit reduction formulas at the margin. The first requires tax revenue from constituencies that oppose expansion. The second requires designing smoother phase-out structures, gradual reductions rather than abrupt cutoffs, which is technically straightforward but politically complicated because it means paying program benefits to households at incomes that some constituencies regard as too high. The result is that program income limits get set at politically defensible levels, not at economically rational ones. The cliff is the product of a political negotiation, not an engineering decision. And the people who fall off it tend not to be the people with the most leverage in the political negotiation. There's a concept in political science called the iron triangle of bureaucracy, the stable, mutually reinforcing relationship between a government agency, the congressional committees that fund it, and the interest groups that benefit from it. The benefit cliff is, in a sense, the output of an iron triangle in reverse. The people who bear the cost of the cliff have the least political organization, the least lobbying presence, and the least consistent electoral participation. Lower-income workers crossing benefit thresholds do not have trade associations, political action committees, or think tanks devoted to modeling the effective marginal rates they face. The people who designed the thresholds were not facing them. The people enforcing them are not facing them. And the people facing them are navigating them in real time, without the analysis, without the modeling tools, and without the information that would allow them to make fully informed decisions about whether to accept a raise, negotiate its structure, or plan around its consequences. One more mechanism deserves to be named explicitly, because it operates quietly and its effects compound over decades: the interaction between benefit cliffs and workforce participation. Research published by the National Bureau of Economic Research and others has documented that workers who are aware of or who have experienced benefit cliffs respond by limiting their hours, declining overtime, refusing promotions, or declining raises, behavioral responses to the economic reality that additional income costs more than it returns. This is not irrational behavior. It is the rational response to a genuine marginal rate problem. But it is frequently described in political discourse and in mainstream media as evidence of welfare dependence or insufficient work motivation, a character-based explanation for a mathematically determined outcome. This misdescription serves the same function as every character-based explanation for structurally produced outcomes we have discussed in this series. It relocates accountability to the individual, away from the system, and insulates the system from the pressure that accurate diagnosis would produce. The exit strategy from the raise trap requires a different kind of financial thinking than the one most personal finance content offers. The conventional advice, earn more, spend less, invest the difference, is structurally correct but operationally incomplete, because it does not account for the nonlinear relationship between gross income and net resources that I have just described. A more complete framework requires understanding your actual marginal rate at your specific income level, accounting for both taxes and benefit interactions, before making decisions about income, hours, benefit structure, and timing. This is the calculation your employer does not do for you. Your HR department is not positioned to do it. Your tax preparer may not have the information about your benefit situation to do it completely. In many cases, you will need to assemble it yourself. The tools exist to do so, and I am going to describe them. The first and most foundational move is to determine your actual effective marginal rate, not the federal bracket rate, not a rough approximation, but the combined rate including federal income tax, state income tax, payroll taxes, and the impact of any income-tested benefits you currently receive. The Urban Institute's Marginal Tax Rate Calculator is the most accessible public tool for this calculation. It allows you to input income, household size, state of residence, and benefit program participation, and it returns a marginal rate at each income level that reflects the combined effect of all relevant systems. If you are in a benefit cliff zone, that tool will show you the zone, the income range where additional earnings reduce total resources. Knowing the shape of your cliff does not eliminate it, but it allows you to plan around it rather than accidentally falling off it. The second move applies specifically to workers who have some flexibility in how their compensation is structured, and more workers have this flexibility than typically realize it. Pre-tax benefit elections, contributions to a 401(k), a 403(b), a health savings account, a flexible spending account, or dependent care FSA. Reduce your adjusted gross income and therefore your taxable income, shifting you down the bracket and in some cases below benefit eligibility thresholds. A worker earning $52,000 who is above the income limit for a specific benefit program might find that a $3,000 401k contribution brings their adjusted gross income to $49,000, below the threshold and restoring eligibility for a benefit whose annual value exceeds the tax benefit of the contribution alone. This is not tax evasion. It is the exact use for which these accounts were designed. And the workers with the most to gain from using them are frequently the workers least likely to have had them explained in these terms. The third move is timing and negotiation strategy, and it applies to anyone who has enough relationship with their employer to negotiate the structure of a raise rather than simply its amount. A raise that takes effect mid-year may interact differently with annual benefit eligibility determinations than one that takes effect in January. In some cases, structuring a raise as a one-time bonus rather than a permanent salary increase, or negotiating a delayed effective date, can allow a worker to remain below an eligibility threshold for a full benefit year before crossing it, giving them time to plan the transition. This is not advice to decline income. It is advice to be precise about when income arrives relative to the program eligibility determination dates that govern the benefits at risk. Precision about timing is worth real money in cliff zones, and almost no one provides this advice because almost no one with the information is facing the cliff. The fourth move is the most structurally important and the least immediately actionable. Understand that the effective marginal rate problem is a policy problem, and that the policy has a known solution. Graduated benefit phase-outs, reducing benefits gradually with rising income rather than eliminating them abruptly at a threshold. Eliminate cliffs without eliminating the programs. The Earned Income Tax Credit is designed this way. It phases out gradually over an income range rather than cutting off sharply at a single dollar amount. The result is a smooth, effective marginal rate curve rather than a cliff. Extending this design principle to Medicaid, SNAP, housing assistance, and child care subsidies is technically straightforward. It has been recommended by the Congressional Budget Office, by the Urban Institute, by economists across the political spectrum. What has prevented it is not technical complexity. It is the political economy of program expansion. The constituencies that would need to support gradual phase-outs at higher income levels have not yet organized sufficiently to move the legislation. Your knowledge of the mechanism and your willingness to support candidates and policies that address it is a more direct contribution to that change than any individual financial optimization. I want to close this video with something I want to be precise about. The frustration you felt when your raise did not produce the improvement you expected was not a sign that you misunderstood how hard work is rewarded. It was a sign that you were navigating, without a map, a system that is genuinely more complex than it is presented to you, and that in certain income ranges affects your outcomes in ways that are counterintuitive, undisclosed, and not your fault. The tax code is not deliberately conspiring against you at every point, but the specific interaction of bracket structures, payroll taxes, and benefit cliffs does produce, at specific income levels, outcomes that are deeply unfair in their distribution of burden. And those outcomes have been documented, analyzed, and left unaddressed by a legislative process in which the people bearing the burden have the least representation. Get the Urban Institute calculator and run your number. Find out your actual effective marginal rate at your income level. If you are in a cliff zone, the knowledge is protective. It lets you make decisions with accurate information rather than with the gross figures that your employer quotes and your HR system displays. If you are not in a cliff zone, the knowledge is still useful because it tells you the true cost of tax-advantaged contributions and the real return on pre-tax benefit elections. In either case, you are now navigating with a map. That map was always available. It just required someone to explain that the terrain is more complicated than the posted signs suggest. That is why your raise felt smaller than it should have. Subscribe for more of this, and I will see you next week.